Would like to thank all of you for dialing into Inox Leisure post-result earnings call for the quarter and the year ending March 2018. The call will be initiated with a brief management discussion on the quarterly as well as the full year performance, followed by an interactive Q&A session. The management team will be represented by Mr. Deepak Asher, Director and Group Head Corporate Finance, Inox Group of Companies, Mr. Alok Tandon, CEO, Inox Leisure, and Mr. Kailash Gupta, CFO, Inox Leisure. Over to you, Mr. Asher, for your comments.
Thanks very much, Ankur, and a very warm welcome to all investors, analysts, and other participants on this call. I'm glad to inform you that the Board of Directors of Inox Leisure Limited concluded their meeting a short while ago and have approved the audited results for the financial year ending March 18. And we've uploaded the results on the website of the company as well as both the stock exchanges. And we've also, along with the results, uploaded an earnings presentation. And my proposal now is to take you through some of the key highlights of that earnings presentation to give you a flavor of how we've worked for the last year, both in terms of financial as well as operating parameters. The numbers that we'll show will be the quarterly numbers, in which we'll do a Y-on-Y comparison, which means Q4 of FY18 will be compared with Q4 of FY17. And then the annual numbers, in which the full financial year FY18 would be compared with the full financial year FY17. Talking firstly of the top line numbers for the quarter, revenue from operations increased by 12% from 288.5 crores to 323.6 crores. EBITDA increased from 25.1 crores to 43.9 crores. That's a growth of 75%. As a result of which EBITDA margin improved from 8.7% to 13.6%, and PAT for the quarter increased from 0.3 crores to 57.7 crores. There is, of course, an extraordinary item of a write-back of tax of earlier years of 53.7 crores, but even if you disregard that, PAT has improved to about 4 crores for the quarter. For the full year, revenue from operations increased from 1,220 crores to 1,348 crores. That's a growth of 10%. EBITDA has improved from 146 crores to 210 crores. That's a growth of 44%. EBITDA margin as a result has improved from 12% to 15.6%. And PAT has increased from 30.6 crores to 114.6 crores. And even if you were to remove that one-off adjustment of tax write-back, the PAT increase would have been 30.6 crores to 60.9 crores. That's again a growth of almost 100%, even after adjusting for the extraordinary item. If one were to look at the breakup of the revenues, as you know, our four key revenue streams are net box office revenues, net food and beverage revenues, advertising revenues, and other operating revenues. For the quarter, net box office revenues increased by 6% from 178.8 crores to 189.5 crores. Net F&B revenues, food and beverage revenues, increased by 18.3% from 65.6 crores to 77.7 crores. Advertising revenues increased by 58.9% from 20.9 crores to 33.2 crores. And other operating revenues increased by 0.4% from 23.2 crores to 23.3 crores. For the full year, net box office revenues improved by 7.2% from 748 crores to 802 crores. Net food and beverage revenues increased by 7.7% from 284 crores to 306 crores. Advertising income improved by 44.4% from 96.2 crores to 138.9 crores. And other operating income or revenues improved by 9.4% from 92.3 crores to 101 crores, as a result of which overall revenues increased by 10% from 1220 crores to 1348 crores. Two significant highlights of the composition of revenues is, for the first time for the full year, we see advertising revenues cross 10% mark of the entire revenue pie, and to that extent, net box office revenues have been within 60%. These results were primarily as a result of the releases that happened during the last quarter, and the top 5 movies for Inox for Q4 FY18 were Padmavat, which brought in footfalls of 26 lakhs and GBOC of 60.12 crores. Sonu Ki Titu Ki Sweetie brought in footfalls of 12.54 lakhs and GBOC of 22.47 crores. Raid, 9.92 lakhs of footfalls, 17.97 crores of GBOC. Padman, 8.19 lakh footfalls and 15.71 crores of GBOC. GBOC, by the way, means gross box office collections. And Tiger Zinda Hai got in footfalls of 8.03 lakhs and a GBOC of 14.21 crores. The aggregate footfalls accounted for by these top 5 movies was 64.72 lakhs, which is 51% of our total footfalls for the quarter. And the GBOC for these 5 films was 130.48 crores, which is 53% of our total footfalls. The corresponding numbers last year for the same quarter was 48% of footfalls and 51% of GBOC was accounted for by the top 5 films in that quarter. Now getting into the operational metrics that resulted into these numbers, footfalls have fallen during the quarter by 3% from 130.2 to 126.3 lakhs. For the full year, footfalls fell by 0.7% from 537.3 lakhs to 533.3 lakhs. Now this we believe was largely because of 2 factors. One, the film Padmavat did not play in about 4 states for us. And secondly, there was a period of strike in the South Indian cinema territory. And our belief is that this accounted for roughly about 24 lakhs worth of footfall loss, both these factors put together. And therefore, had we not seen these abnormal events, one would argue that there would have been an improvement in footfalls by about 5% compared to what we had last year. On comparable property basis, footfalls fell by 5.7% from 119.5 to 112.6 lakhs for the quarter and by 4.2% from 450.3 lakhs to 431.3 lakhs. But as I mentioned, if you corrected for those 2 aberrations, you could probably see similar footfalls as compared to what we had in FY17. There has been a significant improvement in average ticket prices. The overall ticket price for the quarter increased by 10.9% from 174 rupees to 193 rupees. And for the full year, the increase was 8.2% from 178 rupees to 193 rupees. Even if you look at the trend for comparable properties, for the quarter, ticket prices increased by 10.8% from 172 to 190. And for the full year, from 177 to 191, which is an increase of about 7.7%. On food and beverage, the spend per head for the quarter increased by 13.2% from 59 rupees to 67 rupees. And for the full year, the increase was 7.3% from 62 rupees to 66 rupees. The contribution from food saw a marginal dip in the quarter, 76.8% going down to 74.9%. For the full year, the numbers were comparable. 76% in FY17 became 75.7% in FY18. Advertising revenues have seen a significant increase. Quarterly advertising revenues in Q4 FY17 were 20.9 crores. This has gone up to 33.2 crores. That's an increase of 58.9%. For the full year, advertising revenues increased from 96.2 crores to 138.9 crores. That's an increase of 44.4%. And other operating revenues were virtually flat for the quarter, 23.2 crores in Q4 FY17, 23.3 crores in Q4 FY18. But for the full year, we witnessed a 9.4% growth from 92.3 crores to 101 crores. As far as our major cost items are concerned, film distributor share fell on NBOC basis from 43.5% to 41.7% for the quarter, and so a very small increase for the full year from 44.4% to 44.6% on NBOC terms. As far as other overheads per operating screen is concerned, again we've seen a marginal drop. Total other overheads for the quarter Q4 FY17 was 40 lakhs per operating screen. This has gone down to 39.2 lakhs per operating screen, which is a reduction of 2%. And again, on an annual basis also, we saw a similar reduction of 2% from 162.5 lakhs to 159.3 lakhs. Now, that's a brief overview of our financial performance along with some key operating metrics. As far as properties are concerned, we've opened during the year 6 properties with 25 screens and 4,863 seats, We've given to you in the presentation the details of these properties. As a result of this, our total property count by the end of the financial year 18 is 123 properties with 492 screens. This means that we've seen an addition of, on an average, 8 screens every quarter since inception. We therefore remain one of the largest multiplex chain operators in India, present in 19 states, 61 cities, 123 properties operational with 492 screens and 1,21,573 seats. As far as the visible pipeline of screen openings for the next year is concerned, again, we've given you broad details. We expect to open during FY19 11 properties with 55 screens and about 9,802 seats, which, once implemented, would take our total property and screen count by the end of FY19 to 134 properties, 547 screens, and about 131,375 seats. In addition to this, we have also tied up properties, about 108 properties in terms of agreements already signed, with 662 screens and 119,427 seats. Obviously, it's very difficult to give you a timeline for the implementation of this pipeline, but once it is fully executed, we would therefore be 242 properties strong with 1,209 screens and about 250,802 seats once this is fully implemented. The content pipeline looks fairly robust going forward. During the month of May, for example, we've already seen the release of 102 Not Out. We expect Razi to be released later this week. And then there's going to be Deadpool 2, which will be released on 18th May. And then there's Parmanu, Bhavesh Joshi Superhero, as well as Solo Star Wars Story, all happening during May. June is expected to be a blockbuster month with V-Ready Wedding, Jurassic World Fallen Kingdom, Kala, Race 3, an expected blockbuster, The Incredibles 2, and Sanju, all releasing in June. In July, we have Ant-Man, Layla Majnu, Skyscraper, Dhadak, Sahib Bibi Aur Gangster 3, and Mission Impossible Fallout, which is an IMAX format movie, all happening during July. In August, we have Sandeep or Pinky Farrar, Manikarnika, The MEG, Satyamev Jayate, Gold, Happy Fir Baag Jayegi. Pretty good, strong release pipeline going forward. And we are extremely hopeful that this will do quite well. In terms of shareholding data, total number of shares outstanding at this point of time are 9.6 crore shares, face value of 10 rupees. The current price as of yesterday was 267 rupees. The 52-week high-low range was 213 to 326. And at current price, our market cap is about 2,575 crores. The major institutional investors remain more or less what they were last quarter. The promoters and promoter group hold 48.7%. FIIs own about 18.45%. DIIs own about 17.07%. We have treasury shares of about 4.51%. And the public and others own about 11.2% of the total capital of the company. There's also details provided of the consolidated balance sheet of Inox Leisure. What we would like to stress here is we believe that we have one of the strongest balance sheets in the industry with an extremely low leverage of net debt equity being as low as 0.4 times. We have about 115 crores, perhaps more, in treasury stock lying on the balance sheet. We have about 350 crores, perhaps more, of real estate lying on the balance sheet. And our promoter stake is at a very strong 48.7%, which means that we have the potential or the ability to grow fairly aggressively without putting any stress on our balance sheet. So this, ladies and gentlemen, was a brief snapshot of how we performed and where we stand today. I'd like to now open for any questions or any observation that you would like to make. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Amit Kumar from Investec Capital.
Yeah, thank you so much for the opportunity, sir. Just a couple of bookkeeping questions to begin with. If you can just explain, some of these exceptional items, which are there in the P&L this time around. I think an impairment loss of around, 180 odd lakhs, an exceptional of about 8.5 crores, and then there is something on the taxation line as well, a write back of around 50 odd crores. If you can just give us a little bit of color on what's happening here.
So let me explain the tax part first, because I think that's the significant part, and then I'll hand it over to Kailash, the CFO, who will explain to you the other write-offs and the provisions that we've done. So as far as the tax part is concerned, there were certain acquisitions that we had done in the past, which had created in books what is called goodwill. And the issue before consideration before the tax authorities was whether that goodwill was tax deductible or not. Our condition was that it was. But however, since the tax department had not fully accepted it, we were making tax provisions on the basis that this may not be allowed as a deduction. However, happy to inform you that in the last assessments, we've successfully convinced the tax department that it is an allowable deduction. And to that extent, the provisions which were made in the past and what will need to be made going forward as well will need to be lower to factor in the fact that that goodwill will be tax deductible, which led to a write back of the provisions which were made earlier. So that's one of the key reasons. There were some other reasons like, disallowances under 14A, which also we successfully contended were not applicable in our case for reasons that I won't get into details with. But there were certain, as I mentioned, disallowances that we were successful in getting. And this is again based on assessments completed and orders in hand. And because we had the assessments completed and orders in hand, we were able to write those tax provisions back. So that's as far as the tax provision is concerned. Kailash, would you like to address the...
let me come to the exception item of 8.4 crore. So this is about the one property where the fit-outs and everything was, almost in a ready shape. But due to some regulatory issue, we could not continue with that property. So, it has to, so whatever fit-outs, etc. is there, so we have taken a complete provision of that amount because that property might not get the required approvals actually. So this is one. Second, on the impairment part, so we, every property has to go for a testing of its investments basically. So in couple of properties which are quite significant investment has been made, and those investments will be estimated with the kind of return versus the investment. So we have to take an impairment of around 1.8 crore. So this is more of an accounting issue if you see overall basis. So probably the depreciation rate is something which was not enough. So we made it, by way of impairment to those properties.
All right, sir, understood. Very, very quickly, sir, what was the capex for the year, and what is the plan for fiscal 19?
So the capex that we have spent for this year, which is FY18, was roughly about 199 crores. This included capex on new properties of about 161 crores. And the security deposits for the properties that we have signed up of over 29 crores. The plan going forward for FY19, we expect this to be in the range of about 250 to 260 crores.
Okay. And, this will also again include security deposits as well?
Yeah, so there the breakup is roughly about 240 of capex and about 20 of security deposits.
Okay, and 20 crores security. Thank you so much, sir. I'll come back in the queue.
Thank you.
Thank you. We take the next question from the line of Darpan Thakkar from HSBC Securities. Please go ahead.
Hi, thanks for the opportunity. I have 2-3 questions. One is, does this P&L include the revenue from tax-exempted screens as well? I mean, the additional revenue that you used to get before GST. Does that, is it included in the entire year for the FY18 or even for the quarter? Second question, FNB SPH ratio is not gaining since last 2-3 quarters. Are there any steps that are targeted to be taken in the future? So these 2 questions.
Just one sec. Hello?
Yeah.
Yeah, so to get back to you, post GST, there is some confusion about the grandfathering of tax exemptions that we were already entitled to. Until there was certainty or clarity on this grandfathering happening, meaning unless the states came out with policies on how that grandfathering was to happen, we were therefore not able to account for any tax exemptions post-GST. So obviously the exemption benefit was accounted for up to June, but not thereafter. Your second question was, you felt that there was no, what was the question? No improvement in FNB or SPH on FNB?
Ratio of FNB, SPH to ATP. So that is roughly around 35%, same as last year. So
well, in a sense, yeah, that is correct. But to the extent that you see your ATP is going up by about 8 to 10% and your SPH also going up by 8 to 10%, that it's not fair to say that there is no improvement in that ratio. The improvement clearly is in the SPH is going up by 8 to 10%, just as ATP is going up by 8 to 10%.
Okay. So one more question, if I may ask, are there any acquisition opportunities that you are seeing in the available in the market? Or?
Well, we are always happy to look at acquisition opportunities, and there are quite a few in the sense that, there are, apart from these 4 large national chains, there are several 15 to 20 regional players, each of whom have anywhere between 20 to 70, 80 screens, and these would be potential acquisition targets. And we do believe that if the value proposition is compelling enough, we would be happy to look at them.
Okay, thanks.
Thank you. Before we take the next question, I would like to remind all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Urmil Shah from IDBI Capital.
Yeah, hi, sir. Congrats on a strong quarter. So my first question was on the screen ads for FY19. This year, of course, the addition has been weak for factors not all in your control. But going into next year, how confident we are that we can add between 50 and 60 screens?
You are right in the sense that property screen additions in FY18 were not as strong as we ourselves had expected. In fact, if I remember right, we had actually projected at the beginning of the financial year a screen addition of roughly about 45 screens versus what we have actually delivered is about 25 screens. So yes, I do concede that the additions have not been as strong as we had expected. But that has also led us to ensure internally that the guidance that we are providing for screen additions going forward is extremely conservative. And therefore, this 55 screens that we are now indicating would be operational in FY19. We believe are pretty, we are quite confident that we'll be able to do this because wherever there was any element of uncertainty or doubt, we ourselves did not include that in the guidance. And what we put here is something that we are pretty confident of being able to achieve. Just for example, in terms of illustration, out of this 55, there are about 20 screens which are complete in all respects and just waiting for the licenses. So as soon as we get the licenses, these 20 screens could get operational any moment.
Sure. Then I know it will be difficult to time it, but fair to assume that if we have 20 such screens, the screen ads for the year would be front-loaded. I mean, first half having a higher share of screen ads as compared to the second half?
Yes, possibly, yes.
Sure. Then my second question was on the advertisement revenue. Of course, this year has been very strong. How should we look at it from FY19 and 20 point of view?
Well, I think, again, it's going to be difficult to predict or project exact numbers, but yes, our focus has been on improving advertising revenues. That's something that you might recall if you followed the earlier earnings calls we've been saying for the last 6 to 8 quarters. And what we are happy about is the fact that not only have advertising revenues in absolute terms gone up, but they've also gone up significantly on a per screen basis. Just to give you a number, for the full year, it was 22.37 lakhs on a per screen basis in FY17, which has gone up to about 29.8 lakhs on a per screen basis, which is a growth of 33%. So not only, as I mentioned, is absolute numbers going up by 44%, but even on a per screen basis is going up by about 30 to 35%. And we expect a significant momentum of growth to be maintained in this revenue stream. Of course, I'm not going to be able to predict exact numbers, but we feel fairly confident that this is going to be a key revenue and profit driver for us going forward.
Sure, sir. Thank you so much and all the best.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Next question is from the line of Dheeresh Pathak from Goldman Sachs. Please go ahead.
Thank you. Sir, you mentioned 160 crores of capex for FY18 on 24 screens. Per screen capex number is running out to be higher. Am I missing something?
Well, yes. Normally the capex that we incur and the screens that we open do not necessarily go in tandem. Sometimes capex is incurred. As I mentioned to you, there are 20 screens which are already ready, fully capexed, and waiting for operating licenses. So, the capex will be reflected in the balance sheet or the P&L, in the financial numbers, but you won't see that in the operating, the screens operationalized. So there is normally not a perfect, coordination between the capex incurred and the screens opening in a financial year.
Okay. And when you mentioned when you mentioned security deposit, that would sit in loans and advances, or that will be part of...
yeah, that will be in current assets, yes. Current assets.
That will be in current assets. Okay. So 161 in FY18, and what was the guidance, similar like-to-like guidance for FY19? You gave some number, I think.
For CAPEX?
Yeah.
So it's about 240 of CAPEX and about 20 of security deposits.
Okay. So if I understood correctly, what you're saying is the 161 crores you spent in FY18, some of it is spent on screens which will get operationalized in FY19. So
that is correct, but I would assume that it will also happen at the end of FY19 as well. So there will be some capex incurred in FY19 for screens that will actually open in FY20.
So what is on a average basis, how much capex are you incurring per screen now?
You could take roughly about 2.5 to 3 crores.
1.5 to 3. Okay. Thank you, sir.
Thank you.
Thank you. I would like to remind all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Ankur Periwal. Please go ahead.
Yeah, hi sir, thanks. So first, continuing with the ad, growth, this quarter as well as full year has seen a significant benefit of the price hikes that we had taken earlier. Just trying to understand how much of this growth in the quarter as well as year was driven by volume and realization, and what's the growth outlook over there?
Well, I think it is, fair to say it's going to be roughly equal. So if the increase has been about 40%, you could say roughly equally between the volume increase, which is total minutes, as well as the rate increase, which is on the rate per minute. And as I said, I won't be able to give you specific numbers going forward, but we do expect to maintain the momentum of growth in advertising revenues.
Sure. That's helpful. And sir, a second thing, now, the footfall growth, as you, rightly highlighted in your earlier comments, has not been commensurate with the screen additions that we have been, seeing historically. Any specific reasons you could highlight? Because, this has been happening for some time now. So, any insights over there if you could share?
Well, I wouldn't say that the footfall, we haven't witnessed a footfall growth. Had it not been for these two aberrations that I talked about, which was Padmavat not happening in about 20 to 23% of our screens, and also the southern film strike, you would actually have seen an improvement in footfalls. So I do feel that footfall should be able to show a moderate growth going forward as well. So I'm not entirely in agreement with you when you say that there is a concern over there.
So, sir, where I was coming from was, leave apart this quarter. So even if I adjust it for the one-off or even from the full year basis, the growth in footfalls has been slower than the screen additions. So is it only because of the relatively subdued content which we had seen over the last, few quarters, or there is something?
Yes, I think, at a macro level, the, footfalls are largely a function of the quality of content. And unless there is a dramatic improvement or dramatic change there, you wouldn't see a dramatic change in the footfall numbers.
Sure. And sir, lastly, on the ATP front, now this year we have seen a significant growth. Any thoughts over there? Does that 7-8% growth looks likely going ahead as well, or we can see some moderation there?
No, I think so. I think we'll be able to maintain that momentum of growth, because let's also not forget that partly that growth also has been triggered by the fact that we opened some premium insignia screens during the year. And our plan is to keep on, improving our screen mix as well. And as long as, that happens, you would see a fairly robust increase in ticket prices as well.
Sure. Great, sir. That's it from my side. Thank you.
Thank you.
Thank you. We take the next question from the line of Sameer Paradikar from ICICI Securities. Please go ahead.
Yeah. Hello, sir. This is Bhupendra. So my question was particularly on the capex front. I just wanted to understand, so the number that we say 160 crore, and for the total capex that we did in FY17, there must have been kind of a capex which would have done in terms of maintenance or upgrading these screens. So the first question would be, how much of the screens upgradation normally happens? And a follow-up to that would be, what exactly, how much percentage of the screens are premium, and what we are doing in terms of, increasing the pie of the premium screens in our portfolio.
So, again, if you were to look at my total capex to be about 150, 160 crores, I would say roughly 2/3 of that would be on new screens or new properties being opening. And roughly about 1/3 of that would be for renovation of existing units, or, upgradation of those existing units.
And similar would be the ratio for FY19?
I guess so, yeah.
Yeah. So how much screens have we renovated this? How much screens or properties, if you can? And
well, I don't think I have that number in front of me. I probably need to get back to you with those numbers.
And how much is the premium screens right now in terms of overall portfolio?
If I remember right, there should be roughly about 29.
All right. And do we have any particular target that we are moving on to in terms of making this portfolio?
I mean, we have our internal plans, but there's not a target that we are discussing in the public domain.
Fair enough, sir. Thank you, sir.
Thank you. We take the next question from the line of Amit Kumar from Investec Capital.
Yeah, thank you so much for the follow-up, sir. So actually, just on the screen ads bit, given the fact that, in FY18 our target initially was around, I think at the beginning of the year, around 47, 48, we ended up doing around 25. There's a shortfall of around 20. And, in any given year, we, end up sort of guiding for, addition of around 50 screens. So, if anything, because those 20 screens will now come in FY19, I would have expected a, full year sort of screen addition of closer to 65, 70 essentially. Am I missing something here?
Well, yes, again, as I mentioned, because of the fact that every year, we have been not able to maintain our target, we have consciously decided to be a lot more conservative this year and project a very, very conservative screen addition target for this year. And, hopefully we should be, if at all, only be able to surprise you on the positive side rather than the negative side on this.
All right, sir. Just one small follow-up on this. In the third quarter presentation, there was one big, property in Coimbatore that you were planning to launch, almost 2,000 plus, screens. I don't see that in the lineup, this time around, and it hasn't got launched in, 4Q. So what happened specifically with this property? And, is this 8.5 crore of, exceptional item, is that, related to this property?
No, well, first of all, no, that is not related to the Coimbatore property, but what happened on the Coimbatore property, I request Alok to take that question.
Well, here also we are waiting for licenses, and again we said that it's better to be not very aggressive about it, and we are hopeful that we should get the licenses this financial year and open it.
All right, but I mean, it's not showing in the pipeline, which is why I sort of asked this question.
We were conservative in that, and we thought we'll probably surprise you positively.
Yeah, I mean, there's smaller property, 600, 700 screens, it doesn't matter, but a 2,000 crore property, it sort of, gives us a little bit, makes us a little bit jittery, that's all. So quickly on the real estate part, in our past, I mean, you have mentioned this 350 crore amount. I presume this is market value and not book value. Now, in a past discussion, you sort of mentioned that, you don't plan to monetize it because, it was not a very tax efficient, transaction. If you were to sort of sell and lease back, this property. Now, with GST coming in, has that situation changed a bit?
So, the tax inefficiency was arising because of two reasons. One was the service tax on the property rentals, which would not have been set offable. And the second was the tax that you would have to pay, the capital gains tax that you would have to pay on the sale of those properties. So the first obviously has been addressed. The second is not yet addressed. But, in the final analysis, whether you would use this real estate for your funding needs or for your capital raising needs is a function of what the capital cost would be for these properties versus at what cost you could source debt. So as long as I have a balance sheet which is strong enough that enables me to raise plain vanilla debt at about 8.5%, there won't be a need for me to sell and lease this back. So it's a function of optimizing your borrowing cost rather than monetizing this asset.
So just if I'm reading you right, then 8.5% debt rate is sort of the benchmark. If the capital markets sort of worsen and you're forced to take debt at more than 8.5%, then you're better off essentially monetizing these assets. Is that what you're saying?
Right now the cost of debt for me is about 8.5%. If this goes up because of liquidity becoming scarce, we'll also have to see what is the cost of monetizing this asset. If it is, for example, 12%, then obviously the cost of debt needs to be higher than 12% for this to be a more cost-effective way of raising capital.
Okay. Understood. Thank you. That's it from my end.
Thank you. We take the next question from the line of Dhiresh Pathak from Goldman Sachs. Please go ahead.
Thank you again. So is there a difference in the way we calculate occupancy ratio versus how how PVR does it? Because they consistently report better occupancy numbers. So I'm assuming, although we've shown a lesser decline in comparable footfalls versus them, but our occupancy numbers are much lower than what they report. So is there a difference in the way it is calculated?
Well, first of all, I don't know how PVR calculates occupancy numbers, but as far as we know, I think there's a fairly standard way of calculating occupancy numbers, and I don't believe there should be any difference in how we do it.
Okay. So on a, footfall per screen basis, on an annual basis, because I remember you explaining that occupancy is not the right metrics. You look at it at maximizing the footfalls per screen. So that metric is lower for us versus competition. So is it just because of the mix of screen and the location, or have you done any, analysis into that?
Again, typically we don't, we don't on calls like this, we don't directly compare our performance with competition. We just discuss what our performance has been. And on a per screen basis, you are right, the footfalls have gone down from about 31 lakhs to about 28 lakhs for the quarter, and about 1.32 lakhs for the full year to 1.22 lakhs for the full year. That's a fall of about 8%. But this, as I mentioned, would have largely been addressed had those two aberrations not taken place. I don't want to comment on how this compares with anybody else in the industry, because that purely is going beyond the ambit of this call.
Okay. And just want to get your outlook on the ad revenue again, because, you've done a good job this year. So if you can, I think I missed it, or I don't know if you gave that outlook on per screen ad revenue growth.
Yes, I did. And of course, I'm not giving you any growth projections going forward, but what I did mention was that the absolute ad revenue has gone up by 44%, from 96.2 crores to 138.9 crores. Even on a per screen basis, it has gone up by 33%, from 22.37 lakhs per screen per annum to about 29 lakhs per screen per annum. And we expect that the momentum of growth will be maintained going forward as well. Now, whether it will be 33% or higher or lower is difficult for me to say at this stage, but we do expect, because our focus is to make this a key revenue driver for us, and we are working to ensure that happens.
Okay. Thank you.
Thank you. We take the next question from the line of Nilesh Khurana from Athena Investment.
Hi, sir. Good afternoon. Thanks for this opportunity to interact. Just help me understand what percentage of our total box office collection is shared with the producers or distributors, and what has been the trend of this number in the past 3 years, and how do we foresee this number playing out going forward?
Well, again, that's given on the presentation on slide number 8. If you see, depending on whether you compute it on a GBOC or the NBOC basis, on net box office, we in FY17 paid 44.4% out to distributors last year. This year it was 44.6%, and on GBOC it was 35%, going up marginally to 35.1%. So roughly speaking, we pay out about 44 to 45% of the net box office collections, or around 35% of the gross box office collections from ticket revenues to the distributors. And this number, we believe, has been fairly consistent historically, at least for the last 5 or 6 years, and we don't expect any significant change in this going forward as well.
Okay, great. Thanks. That answers my question.
Thank you. We take the next question from the line of Ashish Kumar from Infinity Finance. Please go ahead.
Thank you and congratulations for a good set of numbers. I think a lot of questions have been asked, but my question was in relation to SPH. If you want to make, I know it's sub judice, but if you want to kind of talk a little bit about your perspective about the recent High Court judge's comment in relation to the PI in relation to the pricing of the FNB, and do you see any risk on that margin on the SPH going forward?
Okay. First of all, I believe I need to correct a misconception. If you look at the PIL, it doesn't say anything about pricing. The PIL is for the limited purpose of allowing outside food to be brought into cinema premises. There is no prayer, no request, no mention, no discussion, or no consideration of pricing at all. So I think this is something that needs to be corrected, because some media has reported that this PIL was on pricing, which it is not. We believe, and again we presented this before the court, that we have a right to decide what is brought into the multiplex properties and what is not, for various considerations, including those of safety and security. And when the rules that we have framed are in line with that. We also believe that this is a practice which is not only globally followed for cinemas across the world, but it also followed in a lot of other arenas as well, including, for example, sports fields, drama, hotels, restaurants, and in some cases even airlines. So, we've presented that contention before the court, and I'm sure the court will take a decision that it considers to be fair to both sides. And just as the petitioners have prayed that it is their fundamental right to bring in outside food into cinema premises, our contention also is that it is our fundamental right to decide what is brought into our premises and what is not. But again, the matter is sub judice, and we will obviously defer to the courts to take a fair decision in the matter.
Okay, thank you, and wish you all the best.
Thank you.
Thank you. We take the next question from the line of Girish Pai from Nirmal Bang Securities.
Yeah, thanks for the opportunity. In my earlier interactions with the management, I was made to understand that you would have a very aggressive rollout plan in the NCR region. But when I look at the FY19 pipeline, I see that you're probably setting up just about 6 screens or so. Has anything gone wrong in terms of the expansion in the NCR region?
Well, not at all. What we have discussed is that, yes, we are our pipeline is very robust for the NCR region, and that continues to be there. Again, as we said that we are being very cautious for this financial year, telling you that which properties will open. But beyond FY19, the properties which we have signed will come up for fit-outs, and we'll be opening more screens in the NCR region after that.
Okay. The second question is regarding advertising growth. You mentioned, the momentum would continue. So if I recall correctly, you talked about something like 22 lakhs going to 29 lakhs, so thereabouts, for advertisement revenue per screen. You see the same rate of growth continuing into FY19?
No, as I mentioned, I will not be able to give you a specific number, and if I were to tell you that I see the same rate of growth, that would be giving you a specific number. So I'm afraid I won't be able to do that. I just want to reiterate that advertising revenue is one of our key drivers of revenue growth, and our management focus is significantly on this, and we expect the robustness of growth to continue.
Would you be doing anything differently in FY19 versus FY18?
Well, I think we'll do very well if we continue to do what we were doing, which is exhibit a 33% growth on a per-screen basis and 44% growth on absolute basis.
No, in terms of strategy or operational,
Again, we have several plans. I don't wish to discuss that on an analyst call, but we are taking several initiatives to ensure that this momentum of growth continues.
Okay, thank you.
Thank you. We take the next question from the line of Naval Seth from Emkay Global. Please go ahead.
Thanks a lot for the opportunity, sir. If I have missed out on the F&B gross margin, so any specific reason why that has dipped on sequential basis and outlook on the margins for FY19?
Well, I think to some extent this is a little bit misleading because what it does not, the cost appears to have gone up and the marginal appears to have gone down because of the fact that input tax credit is no longer set offable. What it misses out is that on the top line side, the tax has become lower from 10% to 5%. So that's not captured in the margin calculations.
So is it fair to assume that your FY19 margins would be similar to what we have seen in 4Q, or it will be better than this?
I think it will be fair to assume broadly about 75% of net contribution.
Okay. Yeah, thanks a lot, sir, and all the best.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Next question is from the line of Amit Kumar from Investec Capital. Please go ahead.
Yeah, thanks again so much for the opportunity. So just actually one bookkeeping question which I missed previously. What is the share of Bollywood, Hollywood and regional, cinema, in your circuit for FY18, and what was this number for FY17, please?
Well, I think, again, there's not too much change happening over the last 3 or 4 years. So I have that number handy with me, but I can share with you Hindi, for example, over the last 4 years has been 65% in FY15, 66% in FY16, 65% in FY17, and 66% in FY18. English has been 16%, 14%, 15%, 14%. And regional has been 19, 20, 20, and 20%. So I think the mix consistently has been around 65% Hindi, 15% English, and 20% regional.
All right, sir. Understood. Thank you. That's it from my end.
Thank you. We take the next question from the line of Girish Pai from Nirmal Bang. Please go ahead.
There was some media article which appeared, I think, a few days back regarding the Rajasthan and UP governments, giving you reimbursement on the entertainment tax exemptions under the GST regime. Has anything happened on that score?
So, just to give you the context and the background, the earlier entertainment tax policies provided a tax exemption for new multiplexes for a certain period. For example, in Rajasthan, it was for a period of 7 years, 50% tax exemption for a period of 7 years. From 1st July onwards, once GST came into being, obviously there was no exemption going forward, but the GST rules envisaged that exemptions already granted earlier would be grandfathered. Now, unfortunately, none of the states came up with the grandfathering policies, and therefore we had to regrettably go to the courts, which we did in Rajasthan and UP, to, in a sense, seeking a direction from the court that the state governments be advised to announce their policies. So pursuant to that, I believe Rajasthan has already come out with a tax exemption grandfathering policy. They're examining that as to whether that meets with the requirements or not, in the sense that the whole objective was to ensure that what was promised to us in the past is fulfilled under the GST regime as well. And we expect this to happen in other states as well, because clearly the whole principle of GST was that where exemptions are already granted earlier, these will be grandfathered. Though no fresh exemptions will be granted, but those on the ground of promissory estoppel, what was promised earlier would be continued. And that's what the newspaper article was about.
So this is only from the Rajasthan government and not from the UP government?
As of now, only Rajasthan has announced a grandfathering scheme, but we do expect that more and more states will, because clearly this was something which has been enshrined in the GST legislation.
Just to follow up on that, if and when this thing gets cleared, will the backlog be taken up in one single quarter, or would it be spread out over the many quarters?
Again, difficult to say. We'll have to see how the grandfathering schemes are formed and, whether they give it retrospectively or whether they give it prospectively for the residual period. We'll have to see that.
Okay, thank you.
Thank you. Well, that was the last question. I now hand the floor over to the management for their closing comments.
So, once again, we believe that we've performed quite well, despite the fact that occupancies are not improved significantly. Footfalls have been pretty stagnant, but because of our improvement in average ticket prices, food revenues, advertising revenues, we've been able to show a pretty strong bottom line. And we expect to be able to maintain this momentum of growth in the operating and financial parameters going forward as well. On behalf of the management of Inox Leisure, I'd like to thank all of you for attending this call, and we hope that your interest in this company will continue going forward as well.